Welcome to the fourth installment of the Trestlebridge Capital Education Series, Know What You Own. This is where we explore the thesis behind some of the underlying portfolio holdings. I am your host, Eric Jefferson, and for today's focus, we explore strategies that emphasize high free cash flow. We'll talk about what that is and how it's evolved over time to become one of the most important metrics investment professionals use today. And before we get started, do have a few quick words from our legal team. Then with that, can dive right in by going back in time. If we think to the pre-1990s economy, some of the biggest companies in America all made things, physical goods, whether it was cars or railroads. Maybe they produced steel or mined for coal and oil. In the end of the day, the value of a company was in large part a function of the underlying assets that it owned. That's inventory and infrastructure used to produce their goods. Now, during this time, investment professionals would value a company by comparing the ratio of its price relative to the value of its underlying assets and simply buy those companies that were more attractively valued, all else being equal. And for nearly 3 decades, this was a winning strategy. Not surprisingly, the more attractively valued stocks outperformed those that were more expensive. And again, in this scenario, buying stocks that are cheaper relative to their underlying or intrinsic worth. Now, as our economies entered the digital world, companies began to own fewer physical assets. You think about tech companies that allow you to search the internet would generate millions and millions of dollars in revenue with very minimal physical hardware supporting those operations. And as a result, the winning strategy of buying attractively priced stocks relative to their underlying assets turned out to no longer be the case. For nearly a 30-year period following the transition in 1990, you can see on average, price to book ratios, how investors would value the underlying assets, actually worked against folks more than it did in their favor. And as our economy has continued to evolve, include more services and more innovation, the old measure of a company's value has now been replaced not by what does it own, but ultimately at the end of the day, what does it generate in profit? Referred to differently as free cash flow, which is essentially what is left over at the end of each month, each quarter, each year after a company pays all of its bills. And so I have a hypothetical example here. Let's say you are planning to invest between one of two stocks. Stock A priced at $100 and it generates $3.76 in profit. Company B or stock B, also priced at $100, generates nearly $13 in profit. Now, all else being equal, this is a no-brainer. Option B is the far more attractive choice. Now, we've looked ahead to, or look back rather, to the midpoint of last year, the Russell 3000 index. This is a collection of the 1,000 largest US stocks. On average, had a free cash flow yield of 3.76%. Now, instead of owning all 1,000 companies, which can include some of the largest, even unprofitable tech names out there, if you screened for free cash flow and elected to only own the top 10%, so the 100 highest names, that rate of free cash flow would increase almost 3.5 times. Again, you'd still be looking at that $100 investment, but now would be generating nearly $13 in profit. Now, there are certainly periods of times where markets will ebb and flow, and unprofitable tech companies with esoteric management will become the next meme stock. But since our economy's digital and service transformation beginning in the early 90s, there's been one characteristic that has led in virtually every market cycle, and that is companies that generate more profit relative to their peers tend to do better over long periods of time. And thus, that is one of the major components that we look for, screen, and incorporate our investment process at Trestlebridge. We hope you found this valuable, and as always, more than happy to discuss in greater detail. Take care.